Thank you for taking the time to take a look at our Outlook video. Forgive the somewhat overused title, but as we enter the third quarter, investors are buffeted by the continuing fiasco in Greece, a Chinese economy that's flagging, and a Chinese stock market that is in a little bit of a free fall as of late, a U.S. stock market that has really been flatlined for the year, and of course concerns over what higher interest rates in America will do to not only the economy but stock market. Combining all of these has served to heighten investor anxiety and certainly elevate volatility as we enter the third quarter. Against this backdrop, however, we are standing pat with our belief that as the economy progresses into the second half, we will gather strength domestically such that earnings revision activity will be positive and stocks will climb higher. And also abroad, contagion will be avoided in Europe. As such, the keep calm and carry on seems very appropriate as we enter what will probably be continued volatile markets this summer. Shifting to what is the major topic on people's mind, Greece, the risk of contagion is very minimal in our minds. That's not the case back in 2010. And here we have plotted what the outstanding debt was in terms of Greek debt held by banks, Eurozone banks in the blue, US banks in red, and UK banks in green. And back in 2010, there were about 140 billion euros in total held by those banks. Now, the banks knew what we knew, and that is that the Greeks weren't good for the debt. And as such, they've spent the last 5 years really offloading this debt, getting it off their balance sheet. We don't have current data, but we have through September of 2014, as you can see, a huge reduction from the 140 billion euro neighborhood down to about 38 billion euros, such that the banks, and any one bank's exposure to Greece is very small, so they can absorb the write-offs and essentially, the bottom line, avoid a sort of domino of bank failures contagion that was a very real risk back in 2010. Isn't the case now. Rather, this debt has been shifted from the banks to central bank balance sheets and member nations who are very capable of absorbing the write-offs that will ultimately come from Greece. Bottom line, Greece is a headline risk. It's going to continue to provide volatility for the market, but as far as financial exposure and potential contagion, that risk is minimal to zero in our estimation. Now, shifting gears from an economy the size of Indiana to the world's largest economy, the US, we began the year in a bit of a funk. The combination of severe winter, a West Coast port strike, plunging oil prices that cut earnings in half in the energy patch and cut back spending in capital goods related to energy served to cut GDP down to almost zero. Well, the U.S. has really rebounded, and there's just a couple of data points here. Number one, housing starts have rebounded 50% since the first quarter. The labor market, unemployment continues to fall, and we've had the lowest unemployment claims in 15 years. And finally, one of the themes that we talked about at the beginning of the year, namely that we thought Main Street would do better than Wall Street this year. The consumer has not only continued to get more employed and earn higher wages, but their net worth is at an all-time high as well. So the U.S. economy is definitely out of its funk, moving ahead, and something that we think will bolster equities as the year progresses. Now, one of the things that's helped fuel the U.S. economy has been a continuation of the improvement in the housing. And in our view, housing's really started to break out. What we're plotting here is new home sales. And of course, like any housing indicator, it troughed in 2010 and steadily improved. But as you can see, new home sales really have plateaued for the last couple of years until 2015, where we've had a real breakout here. And this is important because this is a sign of increased consumer confidence. And after all, the consumer is 70% of the U.S. economy, so their willingness to spend on their biggest item, the biggest ticket, housing, is important as a sign for their enthusiasm, their confidence, and willingness to spend, not to mention the increase in jobs that a rebound in housing provides. The improved labor market is ultimately going to translate into higher interest rates. And there's a few dots to connect here, but the punchline is that for over a year now, we've had client portfolios positioned for an anticipated increase in interest rates that didn't come last year. We think this is the year they're coming. There's only one data point on this page, and that's 5.4 million, which is the number of job openings right now in America, which is the most since 2000. And what's really happened as of late is the power has shifted from employers to employees or potential employees. Anecdotally, we gave stats at the beginning of the year such that we had clients who, when they had posted for jobs in 2013, received 200 applicants. We're now receiving 20. Well, the next stage in that sort of development is, as it's harder and harder to find qualified employees for the increasing amount of openings, employers have to start paying up for it, and that translates into higher wages. Wages or labor costs are about 2/3 of the costs in the economy, so as labor costs start to go up, higher wages mean higher inflation. Higher expected inflation translates to higher interest rates. So as this economy, particularly the labor market, gets firmer, this ultimately leads to higher interest rates. Now, this bond market doesn't wait for the Fed to raise rates in order to start moving ahead. And here we're taking a look at what's actually happened with the yield on the 10-year U.S. Treasury this year. After having bottomed here at a yield of 1.66 in February, we're now at about 231. We've been as high as about 245. Now, the flight to quality, given the recent Greek concerns, have taken some of the yield down. But the fact is that investors are anticipating stronger labor markets, stronger employment, higher wage growth, higher inflation. As such, rates have started to move higher. It's not only here, but also abroad. We've seen that if you take a look at what's happened on the yield on the 10-year German bond. After troughing at almost zero, in fact, interest rates were negative out to about 8 years in German bonds earlier this year, but as recently as mid-May, the yield on a 10-year German bond was 7 basis points. Now it's climbed up to over 80 basis points as of late. So the interest rate complex across much of the developed world has started to finally move ahead. Our portfolios are positioned for that with an underweight to fixed income with a shorter duration in our bond portfolio. Again, this is something that we think is not going to be dramatic, but rather a steady sort of climb higher in rates as the year progresses. With respect to stocks, as we said at the outset, it's really been sort of flatline. The S&P's peak this year was a little over 3%. Now we're about flat year to date. And one need look no further than the expectation for earnings to understand why this has happened. What we've plotted here on this chart is consensus expectations for earnings on the S&P since last June. And you start here, back in June of 2014, the consensus was expecting about $132 in earnings on the S&P. And as we progress through time, expectations fell to the point that right now, expectations are for $119 on the S&P 500. Now, the two culprits for this big drop have been, one, the strong dollar, which hurt translation of foreign earnings, and number two, plunging oil prices, which cut the earnings of the energy sector in about half, which took $10 out of estimated earnings on the S&P. It's our belief that as we see strengthening here in the U.S. economy in the back half of the year, we can kind of see it here, hopefully a sort of troughing here on expectations. Right now, consensus for next year, as we're getting into 2016, expectations are for $133 as not only the domestic economy, but the global economy improves. We think that stocks will start discounting this higher number, and rather than a market trading at 17 times earnings, it's trading more like 15.5 times earnings, again, offering value and upside potential. In summary, this Greece continues to unfold in a sort of modern day Greek tragedy is going to provide a lot of volatility for the market. We don't know whether an exit is imminent or whether the can will be kicked down the road. Our guess is it'll probably be kicked down the road through another restructuring, but nonetheless, we don't think contagion is a serious risk. The domestic economy is clearly on the path to further momentum. Rising wages are a precursor to higher inflation and ultimately higher rates, not only here but abroad. Domestic stocks probably range bound until we really see the earnings breakout that we outlined in the previous page. We hope we'll see. Again, hoping for an order of a 6 to 8% return by year end. And because of this, we remain overweight equities, particularly small cap US and Europe on the international front. We're underweight interest-sensitive asset classes and sectors, which means we're underweight bonds, we're underweight REITs, and underweight telecom and utilities. In terms of overweight, we remain overweight energy. That hasn't been the right call in the last month or so, but we think there's a lot of value there that's going to be realized as the economy globally and domestically continues to improve in the second half of the year. Thanks so much for your time and attention. Have a great summer, and we look forward to catching up with you in the fall.